Hello friends, my name is Swami. Heartily welcomes you all to my BReach YouTube channel. The intention behind creating this channel and recording videos is purely an educational purpose and help people to know the journey of achieving financial freedom is possible to anyone in long term. In this video, let me explain how one can be financially free with investing in Sensex 30 index mutual funds. Before talking of Sensex, one need to know what is stock market. Stock market is a place where buyers and sellers meet to exchange equity shares of public companies. Companies list shares of their stock on exchange through a process called an initial public offerings or IPO. Since I explained in earlier videos, there are 7 stock exchanges operating in India. Bombay Stock Exchange and National Stock Exchange are the two major exchanges situated in Mumbai and Delhi respectively. There are only 4% of Indian population invest in stock market. Rest 96% thinks that stock market is very risky and investing in stock markets requires more knowledge. It is wrong assumption and one can significantly minimize the risk by investing in index mutual fund for long term. 8th standard qualification is enough to understand the basic of stock markets. These 96% of the population always confused with what to buy, and when to sell. To wipe out these kind of confusions, investment guru Warren Buffett once said, "No nothing investor can invest in mutual fund and in a systematic way to become rich in long term." What is an index? Index is an hypothetical portfolio of investments holding that represents a segment of the financial market. Let's consider a Sensex index. Sensex is the benchmark index of the Bombay Stock Exchange. It is organized of 30 largest and most actively traded stocks on the BSE. It provides a gauge of Indian economy. One can also call it as a barometer of stock market. The stocks will be selected on the basis of market capitalization. The stocks once selected are not static. They are dynamic in the sense those stocks not performing well will be removed from Sensex and replaced with the best outperforming stocks. Most of the stocks like HFT Watches, Bombay Dyeing, Hindustan Motors were not in the present Sensex index, but they were the leaders in 1980 Sensex. No one can predict which stocks will be part of Sensex for long term. For example, in early 1990s, no one knew that Reliance HDFC will rule the Sensex in 2022. In simple layman language, one can say that Sensex will comprise of best performing top 30 liquid companies. Hence, it is qualified to beat the inflation with a wide margin and help anyone to become financially free when stay invested for long term. And don't fear for the market's fluctuation in short term. Benjamin Graham, an author of famous book The Intelligent Investor, once said, "In a short run the market is a voting machine, but in a long term it is a weighing machine." That means a voting machine counts votes. Votes are based on sentiments of people at a particular given time. Sentiment can change and it is difficult to measure the sentiment accurately. On the other hand, a weighing machine is a much more precise and real. It's easy to measure weight accurately. The value doesn't change quickly, but when it does change a lot, there is a noticeable physical difference. He suggests that in short term, prices are driven by sentiments, while in the long term, trends are driven by something you can actually measure more concentrately, like financial results. Sensex has given 15% CAGR. CAGR means compound annual growth rate during the last 42 years. Let's assume Arun's present salary is 50,000 per month, and after his monthly expenses, he can spare 12,500 and keep invested every month for next 24 years in the Sensex 30 index mutual fund or ETFs. By doing so, he will accumulate 3 crore 52 lakhs. Actually, he invested 36 lakhs in 24 years and his estimated returns were 3 crores and 16 lakhs. Assuming that equity index fund grow with 15% CAGR compounded. Now pause the video and think, is Arun's accumulated 3 crore 52 lakhs is sufficient to be financially free for the rest of his life and he don't need to worry for active income. It is very important to consider the inflation while fetching future value since the purchasing power of money decreases with respect to the inflation rate. Let us say future inflation rate is 6%. Then the value of 100 rupees comes down to 94 rupees after 1 year. Arun's present monthly expenses for his living is 37,500. After every 12 years, his expenses will double with 6% inflation rate. After 12 years, his expenses will rise to 75,000. At the end of 25th year, he need 1,50,000 for his living expenses. If he withdraw just 0.5% every month from his accumulated 3 crore 52 lakhs, after 24 years, he can meet his monthly expenses by doing so. His required money for living is 1,50,000 after 24 years. It is just an example of Arun. Now you calculate when you desire to become financially free and don't depend on active income for your living expenses. You can change the investment amount and the number of years to become financially free as per your income, present expenses for living and the amount you can save and invest in equities. That's all in this video. I am Swami signing off and see you in the next video. I want you to become rich. Like the video, share to your friends, give valuable feedback, subscribe to my channel and don't forget to click the bell button so that you won't miss a notification of the upcoming videos. Bye bye, take care, Jai Hind.